Why the most dangerous moment in trading happens before you even place a trade. On the morning of January 17th, 1995, a 28-year-old trader sitting in a dealing room in Singapore made a decision that would go down in financial history. His name was Nick Leeson. He was talented, he was confident. He had already made his bank hundreds of millions of dollars. People called him a genius. And that morning, just like every other morning, the market opened, the screens lit up, prices moved, and Nick saw what he believed was an opportunity. He entered the trade. That single decision, that one morning entry, collapsed Barings Bank, a 233-year-old institution. The bank that had once helped finance the Napoleonic Wars, gone in weeks. Not because Nick Leeson was stupid, not because his strategy had no logic, but because he entered at the worst possible moment, when the market was at its most chaotic, its most unpredictable, its most dangerous, and he did it with size his system could not survive. Timing destroyed him. Not talent, not strategy. Timing. Today's story is about timing. Not about which indicator to use, not about which pattern to look for, not about some secret technique that professionals know and retail traders don't. It's about one deceptively simple question that every trader faces every single morning. When the opening bell rings, when those red and green candles start flying across your screen, what do you actually do? Do you enter? Do you wait? Do you watch? And more importantly, what happens to your mind, your judgment, and your probability of success depending on which of those three things you choose? By the time this audiobook ends, you will see the market opening in a completely different way, not as a moment of opportunity to chase, but as a landscape to read, a test of discipline before the real game even begins. And that shift in perspective, that one reframe, is worth more than any indicator you will ever learn. Let's start with what actually happens when a market opens, because most people think about it in the wrong way entirely. They think, market opens, prices move, opportunity exists, enter trade, linear, simple, logical. But the reality is far more complicated and far more dangerous. Picture the hours before 9:15 a.m. While you were sleeping, Asian markets moved, European futures shifted, the Federal Reserve released a statement, an oil price changed, a currency fluctuated, some large institutional fund in New York decided to rebalance its portfolio. All of that, every piece of that global activity, was building up pressure overnight, like a compressed spring. And then the opening bell rings, and that spring releases all at once. Every institutional order that accumulated overnight gets executed simultaneously. Every retail trader who was watching global markets and made pre-market decisions hits their buy or sell button in the same window. Every algorithm that was waiting fires in milliseconds. The result? Pure, unfiltered chaos. Prices move violently in both directions, volume spikes to levels that will not be seen again, until the close candles form that look meaningful, but carry almost no information about actual direction. And sitting in the middle of all this is you. Heart rate elevated, screen flashing, brain screaming. Is this a move? Should I enter? What if I miss it? Mark Douglas, one of the most important thinkers in trading psychology, spent decades studying why intelligent, prepared traders consistently made the same mistakes over and over again. And what he found was not about strategy. It was not about intelligence. It was about this. If you're afraid of the market's uncertainty, you will be condemned to repeat your mistakes. Read that again slowly. He's not saying uncertainty is the problem. He's saying that your fear of uncertainty, your inability to be comfortable with not knowing, that is what creates the cycle of repeated mistakes. And the market open, those first 15 minutes, is the single greatest trigger of that fear in a trader's entire day. Not because something terrible is happening, but because everything is happening at once. And the human brain, which evolved to detect threats and respond instantly, interprets that chaos as danger. And danger triggers reaction. And reaction in the market almost always means loss. Let me give you a mental image that I want you to hold on to for the rest of this audiobook. Imagine a stadium. Tens of thousands of people outside, waiting to get in. The doors are locked. Everyone has been standing there for hours, some excited, some anxious, some with specific seats in mind, some who don't even know why they came. And then the doors open. What happens? Chaos, pushing noise, people moving in every direction at once. You cannot tell where the actual flow is going. You cannot tell who is heading to the good seats and who is just being pushed by the crowd. If you tried to navigate to a specific seat in that exact moment, you would likely end up somewhere random, pushed by forces you don't understand, in a direction you didn't choose. But if you waited just 15 minutes, the crowd settles, the pathways become clear. You can see exactly where to go, and you can walk there calmly without being swept somewhere you didn't intend. That is the market open. Every single day. The doors open at 9:15, the crowd rushes in. And for the next 15 minutes, the only smart move is to let the chaos settle before you try to navigate it. But here is the uncomfortable truth about why most traders don't wait. It's not because they don't know they should. Most traders who've been in the market for more than a few months know intellectually that the opening is dangerous. They've been told. They've read it. They've probably experienced it firsthand, entered a trade at 9:17 and watched it immediately go against them. They know. And yet, every morning, they do it again. Why? Because knowing something and being able to act on it in a moment of emotional intensity are two completely different things. The opening bell creates what psychologists call a trigger state. Your brain detects movement, opportunity, the possibility of gain or loss, and it activates systems that are much older and much faster than rational thought. The prefrontal cortex, the part of your brain that follows rules, thinks long-term and executes planned strategies, gets overridden by the limbic system, the emotional brain, the survival brain. And in that state, no matter what you know, you react. The big institutions understand this perfectly. They know retail traders will be emotional in the first 15 minutes. They know fear and greed will be at their peak, and so they deliberately create what traders call traps. Moves that look like breakouts but are actually reversals, specifically designed to harvest the impulsive entries of retail traders. A sharp move up, retail buyers flood, and the move reverses. Their stops get hit. sharp move down, retail sellers panic. The move reverses. Their stops get hit. This is not conspiracy theory. This is mechanics. This is what happens when professionals trade against emotional participants. And the opening 15 minutes is where retail emotion is highest and most exploitable. So what does the right approach actually look like? What does a disciplined, professional-minded trader do when the market opens? The answer is both simple and surprisingly difficult. They observe. Not analyze, not strategize, not look for entries. Just watch. They let the opening chaos play out in front of them like a show they have no stake in. They watch where price goes. They watch how volume behaves. They note where price stalls, where there seems to be genuine resistance or support emerging from the noise. They ask quiet questions, not urgent ones. Where did price close yesterday? Is today opening above or below that level? When price moved sharply, did it find buyers or sellers at the previous significant levels? Is volume confirming the direction of the move? Or is this just a low conviction spike? These questions don't generate immediate trading signals, they generate context, and context in trading is everything. Because a trade taken without context is a gamble. A trade taken with context is a calculated decision. Mark Douglas had a way of explaining this that I find deeply useful. The consistency you seek is in your mind, not in the market. The market will never be consistent. It will surprise you, confuse you, move in ways you didn't predict, reverse when you were certain it wouldn't. That inconsistency is not a bug, it's a feature. If markets were perfectly predictable, they would offer no opportunity at all. But your approach to the market, your process, your discipline, your ability to wait for the right conditions that can be consistent. And when your process is consistent, your results, over time, become consistent. The first 15 minutes of every trading day is your first test of that consistency. Not a test of your analysis, not a test of your chart reading, a test of whether you can sit with uncertainty and not react to it. And every day you pass that test, every morning you choose observation over impulsive entry. You are building the mental muscle that separates traders who last from traders who don't. Now let's talk about what happens after those first 15 minutes. Because the story doesn't end with patience. Patience is just the setup. The real question is, what are you waiting for? And how do you recognize it when it arrives? Somewhere between 9:30 and 10:30, the transformation begins. The opening rush has passed. The institutional orders that were queued overnight have mostly been executed. The panic buyers and panic sellers from the first wave have either made their money or taken their losses and stepped back. And what remains is real demand and real supply. This is when the chart starts to tell you something true. Price begins to respect level support, actually holds resistance, actually pushes back, volume aligns with direction rather than contradicting it. And most importantly, a structure begins to form. Structure, that word is worth spending a moment on. In trading, structure is what separates a meaningful price movement from random fluctuation. Think of it this way. Imagine you're watching a river. Right after a storm, the water is churning. There are waves, eddies, conflicting currents. It's impossible to tell where the main flow is going. But an hour later, when the storm is past and the water begins to settle, you can see it clearly. The river is moving in one direction. The current has a shape, a pattern, a logic. That is structure. And in the market, structure forms after the opening storm has settled. If buyers are genuinely dominant, you see higher highs and higher lows forming. Every dip gets bought, the market is making a series of steps upward, each one building on the last. If sellers are in control, lower highs and lower lows, every recovery gets sold. The steps are leading down. When you can see structure clearly, when you can identify which side is genuinely in control, and with what level of conviction, that is when entry becomes logical instead of emotional. That is when probability shifts to your side. And here's where I want to address the belief that quietly destroys more trading accounts than almost any other single idea. The fear of missing out. You're watching the market at 9:18, a sharp move is happening. It looks like it could be the beginning of something big, and a voice in your head, urgent, insistent, says, if you don't get in right now, you are going to miss the entire move. That voice has a name. Traders call it FOMO, fear of missing out. And it is, without question, one of the most expensive emotional responses in trading. Because what that voice never tells you is this: the market will give you another opportunity. Not the same opportunity, a different one. But one that is clearer, safer, with better probability and better risk management potential. The market opens every single day. Every day, new setups form, new entries appear, new trends begin. But your capital, the money in your trading account, that is finite. It does not regenerate automatically. A bad entry at 9:17 that cost you 2% of your account is not just 2%. It is the capital you needed for the cleaner, higher probability trade that was going to form at 9:45. Every impulsive loss is a double loss: the direct financial loss and the opportunity cost of what you could have done with that capital instead. Mark Douglas put it in the most direct possible terms. Your biggest challenge is not the market. It is fighting your own emotional impulses. Not indicators, not news, not global events. Your own impulses. The impulse to enter because something is moving. The impulse to exit because something is falling. The impulse to revenge trade after a loss because you need to get it back. These impulses feel like logic in the moment. They feel like smart, decisive action, but they are emotional reactions wearing the costume of analysis. And the antidote, the only real antidote, is a process that is stronger than your impulses. A process that says, I observe the first 15 minutes. I wait for structure to form. I enter only when direction and conviction are both clear. I manage the trade according to my rules. When that process is stronger than your impulses, trading changes completely. Now I want to talk about the second productive window in the trading day. Because many traders, especially newer ones, treat the entire day after 10:30 as dead time. They either overtrade or they stop watching entirely. Both of those are mistakes. Between approximately 1:30 p.m. and 2:30 p.m., something interesting consistently happens in markets. The morning session has fully settled. Participants who are active at open have made their decisions. The midday lull, which is genuinely slow and often best avoided as past. And now, a new wave of activity begins. European markets have been open for hours. US pre-market is starting to warm up. Institutional players who spent the morning in meetings and strategy sessions come back to their terminals. New information has accumulated since the morning. Positions that were held through the midday are being reassessed. The result: fresh energy enters the market. If the morning trend was strong, this afternoon session often confirms and extends it, giving you a second entry opportunity in the direction you already identified. If the morning trend was weak or choppy, this window sometimes generates a completely new direction, a fresh breakout or breakdown with genuine conviction behind it. For a trader who spent the morning observing and waiting, this is often where the real work happens. The setup that the morning didn't deliver, the afternoon sometimes provides. But there is a third time window I need to address, not as an opportunity, as a warning. The final 30 minutes before market close. If you are a beginning or intermediate trader, this window is not for you, not yet. Here is why. In the final 30 to 45 minutes of the trading day, intraday traders are closing their positions. They have to. They cannot hold overnight. And the result of thousands of positions being forcibly closed at the same time. Artificial, unpredictable volatility. Price can spike dramatically in either direction, not because of any genuine market force, but simply because of mechanical closing activity. A move that looks like a breakout is actually just someone squaring off a large position. A sharp reversal that looks like a signal is actually just automated stop losses triggering in a cascade. For experienced traders, this volatility can be traded. They know its patterns. They understand its mechanics. For everyone else, it is the second most dangerous time of the trading day, second only to the opening 15 minutes. Observe it, learn from it, but do not trade in it until you have years of market experience behind you. So let us bring this into something practical, a clear, clean framework for how to think about the trading day. The opening 15 minutes, 9:15 to approximately 9:30, is the observation zone. Your only job is to watch, to understand what overnight forces have created, to note the important price levels, to let the initial chaos settle without participating in it. The first productive window, 9:30 to 10:30, is where structure forms and your first high probability entries appear. This is when direction becomes visible and conviction becomes measurable. This is where disciplined preparation meets opportunity. The midday period, roughly 11 to 1, tends to be slow, choppy, and low conviction. Many professional traders barely touch their screens during this window. For newer traders, it is often better to simply step away, review the morning, and wait. The afternoon window, 1:30 to 2:30, offers a second opportunity. Fresh institutional activity, new direction forming or morning trend confirming. A genuine second chance for traders who were disciplined in the morning. And the close, the final 30 minutes, is for observation only, unless you have deep experience with its specific mechanics. That is the architecture of a trading day, not a continuous stream of opportunity from open to close, but a series of distinct windows, some for action, some for waiting, some for learning. Now here is the part of this conversation that most people want to skip. Because we've talked about when to trade, we've built a framework, we have a plan. But if trading was simply about having a plan, everyone would be profitable. The real question is not what the plan is. The real question is why most traders abandon the plan the moment the market opens. And the answer is psychology. Specifically, the gap between knowing what to do and being able to actually do it when money is on the line and prices are moving, and your screen is flashing, and your body is pumping adrenaline. Mark Douglas spent his career studying this gap, and what he found was both humbling and hopeful. The market doesn't create your emotions. It triggers what is already inside you. This is one of the most important sentences in trading psychology. If impatience is inside you, the market will bring it out. If greed is inside you, the market will amplify it. If fear is inside you, the market will weaponize it against you. The market is not your enemy. Your unexamined inner landscape is your enemy. And this means that improving as a trader is not primarily about learning more strategies. It is about understanding yourself, your triggers, your impulses, your default responses under pressure, well enough to create a process that protects you from yourself. Let me make this concrete with a concept that Douglas called probabilistic thinking. Most traders, especially newer ones, approach each trade looking for certainty. They want to know, is this going to work? Is this the right entry? Will the market go in my direction? They want confirmation. They want safety. They want to feel sure before they act. And the market, being what it is, never provides that certainty. But here is what Douglas understood that changed everything. You do not need certainty to make money consistently. You need probability. A trading edge, a genuine edge, does not mean you win every trade. It means that over a large enough sample of trades, you win more than you lose, or you win big enough and lose small enough that the math works in your favor. A strategy that wins 60% of trades still loses 40% of the time. 40 losses out of every 100 trades. If you are looking for certainty, you will be paralyzed by those 40 losses. You will second guess your system. You will override your rules. You will quit the strategy right before it goes on its winning run. But if you genuinely internalize that each trade is just one data point in a much larger statistical sample, if you truly accept that you don't need this individual trade to win in order for your system to be profitable, something remarkable happens. The anxiety around each trade evaporates. You can enter without hesitation because you're not betting everything on this one outcome. You can take a loss without emotional damage because it's just one of the 40 you expected to lose. You can let a winner run because you're not desperately trying to lock in profit before the market takes it away. You can just trade cleanly, consistently, without the constant internal negotiation between your rules and your fears. There is a beautiful concept in this space that I want to spend a moment on. The idea of discipline. Not as a personality trait, but as a design choice. Most traders treat discipline as something you either have or you don't, as if it is a character quality, like height or eye color. Either you're a disciplined person, or you're not. This is completely wrong. And this misunderstanding causes enormous suffering. Because when traders fail to follow their rules, when they enter early, or hold losers too long, or revenge trade after a loss, they tell themselves a story. I am not disciplined, I am not cut out for this, other people can do this, but I can't. the truth is much simpler and much more fixable. They failed to follow their rules not because they lacked discipline, but because they did not design their environment to make following rules easier than breaking them. A trader who decides, I will only trade between 9:30 and 10:30, and again between 1:30 and 2:30, and writes that rule down, and sets a reminder, and closes the platform outside those windows, is not relying on willpower. They are designing a system, and systems are more reliable than willpower, every time. Discipline is not about being stronger than your impulses. It is about building structures that make impulsive action less available. Let me give you the most honest version of what this looks like in practice, because I want to be real with you about the difficulty before I talk about the rewards. You will sit down one morning. You've done everything right. You watch the open. You let the noise settle. You identified structure. You have a clean setup forming in your productive window. And then, at 10:45, just as your window is technically closing, a massive candle forms on a stock you've been watching. Volume explodes. It looks like the beginning of an enormous move. And everything inside you will scream, this is it. Get in now. That moment, right there, is the real test. Not the knowledge, not the framework, that specific moment of temptation, when everything you know says wait, and everything you feel says go. The traders who survive long-term are not the ones who never feel that pull. They feel it every time. They've just built enough process, enough structured habit, that the pull does not control the outcome. And they have seen, through painful personal experience or through the experience of others, what happens on the other side of that impulsive entry often enough that the memory of those outcomes creates its own kind of discipline. Here is something I find deeply encouraging in all of this. Trading is one of the very few disciplines where self-awareness is directly, measurably profitable. In most areas of life, the relationship between psychological growth and financial reward is indirect, long-term, and hard to trace. In trading, it is immediate. The day you stop entering in the first 15 minutes, your account stops taking those losses. The day you genuinely internalize probabilistic thinking, your relationship with your stop-loss changes entirely. You honor it cleanly, because a stopped-out trade is no longer a failure. It is just one of the 40 you expected. The day you truly commit to your productive windows, the quality of your setups improves immediately. Not because the market changed, because you started seeing better opportunities. Every psychological improvement shows up in your trading results almost instantly. That feedback loop, that direct, immediate connection between how you think and what you earn, is one of the most powerful growth mechanisms in any professional field. And it means that the work of understanding timing, of understanding why you enter when you enter, and what is really driving those decisions, is not just philosophical. It is practical. It is financial. It is the actual work of getting better. Let me bring together everything we have covered, not as a summary, but as a picture. Picture a professional trader on a normal morning. They're not excited when the market opens. They are not anxious. They sit down, note the key levels from yesterday, check the global overnight context, and then they watch. The first 15 minutes play out in front of them like a weather report. They gather information. They observe which levels are being respected and which are being broken through. They note the volume. They feel the rhythm of the market without being swept up by it. Around 9:35, something starts to clarify. Structure begins to form one side. Buyers or sellers begins to assert genuine dominance. The noise is reducing. The signal is emerging. By 9:45, there is a setup, clean, logical, with a clear entry point, a defined stop loss, and a reasonable target. They enter, not with excitement, not with a racing heart, with a calm, almost routine feeling of executing something they have done hundreds of times before. The trade plays out. Maybe it works, maybe it doesn't. Either way, they followed their process. They traded in their window. They made a decision based on structure and probability rather than emotion and impulse. And that is a win, regardless of the outcome. Because that kind of trading, repeated consistently day after day, is what builds a profitable career. Not the dramatic trades, not the huge wins, not the stories worth telling at dinner. The boring, disciplined, methodical execution of a sound process. Mark Douglas left us with something I want to end on. Because of everything he wrote, everything he taught. This is the line that I think captures the entire game of trading in a single sentence. You don't need to know what is going to happen next to make money in the market. Read that again. Let it sit. You do not need to know what is going to happen next. You do not need to be right about the specific trade. You do not need to predict the next move. You do not need to see the future. You just need to be in the right place, at the right time, with the right process. The right place is where structure is clear and probability is tilted in your favor. The right time is after the noise has settled and the signal has emerged. The right process is one that you follow consistently, regardless of what any individual trade does. That combination, place, time, and process, is what trading actually is. Not prediction, not certainty, not courage, patience, observation, and the quiet discipline of doing the same thing correctly over and over again, until the probabilities that were always on your side have had enough room to express themselves. Every morning, before you place your first trade, the market opens and asks you a question. It asks, are you here to react? Or are you here to observe, to wait, and to execute when the moment is actually right? Your answer to that question, not your strategy, not your indicators, not your risk management. Your answer to that single question is what will determine whether you are still trading 5 years from now. The market will always be unpredictable. Your process does not have to be. Trade at the right time and let everything else take care of itself.